Hello and good morning, folks. Welcome back to Almus Market Mornings with Shikhar Garg. Yesterday, we had the State of Economy report released by our central bank, and I'd like to highlight a few points out of there. The central bank stated inflation may have been slightly down, but it's certainly not out, basically cautioning that inflation is not yet done. Another caution was on the economic performance as the global outlook darkens. Emerging market economies won't be in isolation, rather, will be vulnerable to this. But on the positive side, it was the turn up on the investments in the fixed asset, which probably is being looked after as a new capex cycle. So, JK, few of the pointers out here, basis the concerns and the positives. What's your take? What are the things in your radar?
Uh, Definitely, it was more of Japan-related news that has been, still making waves among the traders. In fact, it was a shock and wave from BOJ yesterday, with hardly anyone expecting a policy change in the last 10 days of calendar year when the markets are really thin. And we all woke up to that macro surprise, widening of JGB 10-year bond yields by 25 basis points. And on the face of it, that's not a big change, but the implications are huge. The move being necessary because the Japanese bond market had now become non-functional. BOJ holding 50% of all the bonds and buying up all the issuances recently. And the governor tried his best to minimize the market expectations of further policy changes, stressing that today's move is not the first step towards an exit, and a further widening of the yield band is not needed. However, he may have paved the way for further policy moves higher after he steps down. And all said, the central bank seems to have lost a lot of credibility on its future guidance. And most believe that the new sheriff in town approach is relevant because it signals this is not a one off move, but a rather sustained shift in the approach to monetary policy and implications. And I see this move as a matter of time, bringing in tighter policy in Japan, maybe 6 months down the line. And that means more strength in the yen in the months ahead, particularly if we have easing of US yields. In the short term, you will see 130 as a line in the sand, and a break there could see further large gains for the USD yen to fall. With a massive fall in dollar yen, dollar index is having another look below 104, and it seems topside is getting more and more limited for the dollar. With the euro staying firm and now yen performing, I feel the upside for the dollar index may be limited to 106, and that's a level where 200, day moving average lies for the dollar index, and prices have traded below it for quite a length of time for it to become a good resistance. And we had a series of dollar positives getting reversed, and possibly, I would say, series of negatives for other currencies getting reversed in the last 3-4 months. Possibly that is also defining near-term top for the dollar. We had a big reversal in GBP after fiscal prudence being reintroduced, and China reversing their COVID zero policy, ECB getting more and more hawkish, and now Japan. And add to all this, falling inflation and possibly topping in interest rates in US, we have a perfect recipe for a sustained downtrend in the dollar. The move of BOJ triggered further up moves in yields across countries. Already got a boost from last week after European Central Bank's hawkish press conference. Australian benchmark 10-year rose 20 BPs, UK by 14, 33 BPs from the previous day low. German by 7 BPs, rising 55 BPs from the low of this month, particularly taking influence from the ECB. US yields in 10-year were up 13 basis point, again 28 BPs from the recent close. So unless we see a significant fall in inflation in the coming months, these moves are likely to build up and can set up for another bond market turmoil in the new year. The current, buying which was seen in the last few days may have been safe haven move in view of the risk assets falling. Let's also remember that two leading central bankers, Fed and ECB, have been most hawkish in their statements and trying to negate the market expectations of an earlier tightening pause. On the data, we had US housing starts that was somewhat better than expected. And also the building permits, of course, continue to slump. And today, Eurozone consumer confidence also overnight improved slightly, adding to the slew of better data from Europe. And today we have a current account and the consumer confidence from the US. So not top tier, but definitely something to watch for in the overall picture. We should expect the dollar trade to slowly slow down and led by dollar yen, which is still on the limelight. Maybe 130 holds for now till the new year, but a breakup that can open the floodgates for more gains for the yen. Rupee, nothing new to add. We are still in the range of 60 and 90, and definitely break of 40. 80 to 40 and 83 on the higher side can set the direction. Still looking at the overall dollar index fall and also the EM currencies gains. Rupee has a lot to catch, but a lot depends on the central bank. Thank you.
Okay, JK, that was quite good. And yes, folks, the updates or the shocker from the Japanese central bank was still rocking the boat for the financial markets, with the implications far reaching than what is being anticipated. And it's interesting to watch, JK, as you mentioned, this shift in stance by the Bank of Japan, because tightening was something which was not looked upon after by them for years, and now it's this change in stance. Other than the Japanese surprise is the fact that there's a possible bond market turmoil on the cards if the inflation doesn't shift anytime soon. So, folks, we are in for a ride even in the next year. Things have not yet settled, but on the domestic front, as you can all see, the domestic currency INR against the dollar is yet to catch up with the trends, and it has been on the underperforming side in the past week, majorly being in a very narrow range. But we shall come up with further updates for its directional expectations. That's it for today, folks. Thank you so much for listening, and we shall come back again tomorrow.